Pete Robinson from CIP Asset Management. Welcome to the Alternative Symposium.
Thanks for having me.
Can you explain the basic approach of the credit income strategy?
Sure. The Credit Income Fund is a strategy that tries to draw the best of both private and public debt markets. So what we do is we take an approach via a fund that offers monthly liquidity with a 10% fund level gate that allows us to invest in those less liquid parts of credit markets. We don't speculate on interest rates or currencies, and instead we drive returns through credit spreads and illiquidity premium to achieve a return of cash plus 3% after fees, which we think is about 1 to 2% above traditional income-based strategies.
And what does that universe look like on the public and private side in terms of kind of asset classes, different parts of the capital?
Yeah, absolutely. So on the private side, we're really focused on Australia and New Zealand. That's where our competitive advantages are and the bulk of our team is based, and the 15-year history that we've got in private debt markets is all exclusively Australia and New Zealand. We're focused on stabilised commercial real estate lending, corporate lending, either sponsor or non-sponsor backed, and asset-backed finance. In the public markets, we're focused globally, developed markets, corporate bond, and ABS or asset-backed securities.
And which inputs do you expect to have the biggest influence on fixed income and credit returns over the next few years?
Yeah, it's a great question, and I think one that a lot of investors are grappling with right now. I think our view is not really directional on markets, so we don't necessarily think interest rates are going to go up or down materially. We don't have a high degree of confidence in that prediction, nor on credit spreads. So we think the bulk of the return over the coming years is really going to be through carry, so interest, receipt of interest payments and credit spread returns.
And how important is risk management and actively managing those allocations going to be in the next 12 months?
Yeah, I think it's crucial right now. I think the environment we're in is an environment where uncertainty is really dominating the landscape across all markets, but particularly in credit and fixed income markets. Managing that uncertainty and managing that risk, the risks around that uncertainty is key. And importantly, it drives a lot of opportunity because uncertainty creates inefficiencies of markets. And so positioning yourself actively to take advantage of those by either rotating from public to private or vice versa and rotating between those sub-asset classes can really add value.
Is there one sector that stands out as the best opportunity at the moment?
Yeah, I think on the private side, we are seeing great opportunities in the corporate space, particularly on the secondary side. So we are seeing more motivated selling as sellers look to rotate back, say, into their home markets where there has been material repricing. And so you are seeing people sell at prices where we haven't seen value in a number of years.
And can you expand on that idea of secondaries as well?
Yeah, so I think, when we talk about private markets, there's perhaps a misnomer that it's completely liquid and never trades. In fact, loans can trade, often loans are syndicated with multiple buyers and multiple sellers in them, even if the loans aren't publicly rated or publicly valued. We've been an active player in these markets, like I say, since 2005. So our ability to access those opportunities both on the primary and secondary side, so buying a loan off someone who's a seller at a discount to par is particularly attractive right now.
And how important is that deal flow in a more challenging or volatile market?
Yeah, I think by seeing more deals, you make better decisions. You can compare relative value. You can assess the difference in structures and terms on transactions. And so that's a really key part of our approach. Because we've been doing it for so long and we can provide scale and flexibility of capital, I think we get a first call and we really pride ourselves on that. So we have what we call a first call approach or a first call mentality. We want to get that first call on a transaction. We see more deals and we can make better decisions.
Pete Robinson, thank you.
Thanks for having me.